how to choose your mortgage lender. In other words, how to choose which bank you want to take your home loan or mortgage. You do not really choose the bank for your mortgages. In most cases, banks actually choose you. What? 3 problems that you need to know and sort out before you can successfully get your mortgage approved. These 3 common problems that will make your loans being rejected by the banks as you are applying for a mortgage to buy a property or a real estate. First one is your credit rating in the form of CRIS or CTOS in Malaysia. Now, not a single person can escape from this. I have a full-fledged article and instruction video for that you can watch after this video ends. Just click on the upper right hand corner after you watch this video. Now, if your credit history are bad and these are actually recorded in the system and it will be exposed when you try to apply any kind of loans, not only mortgages, but any kind of loans from the bank. That is like you have a smelly feet and you date a lady in your office building. And then after you guys broke up, this lady, he just posts on Instagram on how you, as the ex-boyfriend, have a smelly feet that she really cannot stand anymore, and you really have already a bad hygiene. You refuse to bathe more than once a week. If that is out in the public, everyone will know you actually smell so bad that no other lady or woman would want to date you from there on. So that is the analogy for your CRIS or CTOS record. Now, the second thing is about your debt service ratio, your current monthly loan repayment, whether it's credit card, whether it's personal loan, whether it's PTPTN loans, student loans, or your existing car loan, or your existing home loan. You have to actually consider all that in, and then you have to divide that with your current monthly income, and then it should be a certain percentage. This is what we call as the ratio, the debt service ratio, and if it exceeds a certain percentage point, you have too much commitment to actually pay every single month, and because of that, banks do not want to lend you any money anymore. Here's where the complication comes in. There are 5 of them, and I'm going to tell you each one. The first one is gross income versus net income. Some banks may take gross income and some banks may take net income to calculate the debt service ratio, or DSR. The second one is variable income in the form of commission, overtime, or allowance, whether it is fixed or variable. Bank A may only consider 70% of your variable income. Some banks may consider 80% of your variable income, whereas some banks may consider fully everything that you declare as a commission, overtime, or allowance, subject to certain terms or conditions. Yearly bonus that you receive in the form of contractual or fixed bonus, or in the form of variable or performance-based bonus. Some banks may consider them, some banks may not. Now, if they are going to consider that, then it is also a question of what are the terms and conditions for the banks to consider that. Example, there might be certain documentation that they need in the form of EA form or your payslip, and it may consider fully what you receive, or it may only consider partially of what you receive. And of course, some banks may not even consider this at all. Or if you don't have that form of yearly bonus, then basically you don't really need to care about this. If you already have some form of rental income, then you must submit documentation that you receive that rental income. And some banks might even need you to submit a tenancy agreement and things like that. But some banks will only consider 70% of your rental income, some banks 80%, and some banks may consider full of your rental income to be something to calculate your debt service ratio. The debt service ratio, or DSR criteria, may also vary from bank to bank. It's not always at 60, 70, or 80%. Now let me explain why. For example, Bank A may have in detail this kind of DSR evaluation. If your salary or if all of your income combined, rental, fixed, and variable income, is between 3,000 to 5,000, the debt service ratio upper limit might only be 55%. Now, if you're from the perception of the bank, if everything considered, your income falls between the range of 5,000 to 8,000, then the debt service ratio upper limit is 60%. If, say in this example, if you're from the perception of the bank, your income every month is 8,000 to 10,000, then your upper limit with debt service ratio is 70%. Likewise, your debt service ratio would be at 80% if your income exceeds 10,000 a month. Now, For the very same thing, if you go to Bank B, if your income between 5 to 10,000, then you cannot exceed a 70% debt service ratio. If not, your loan application will be rejected. But you will be qualified for 85% debt service ratio if the perception of the bank, all of your income combined, actually exceeds 10,000. We have done a tool that you can use on your PC, on your tablet, and on your phone. One click. And this calculator is what I call as How Banks See You calculator. Because step 1 of using this calculator is basically to enter every of your cash flow or income that you have on a monthly basis, including your yearly bonus. And then you can see in one page how much does a certain bank actually consider how much you are earning from the eyes of the bank. Now that is really important because it does not really matter how much you earn from your fixed or variable income. The important part is how banks perceive how much you earn. And as I say, because banks have different evaluation criteria, this is the important inputs that comes to actually compute your total debt service ratio. So this kind of one-click tool enables you to plan ahead to gauge which bank is likely to actually reject you because you exceed or at the borderline of a certain debt service ratio based on your current income, and which banks are actually more likely to approve your mortgage application. So this is critical when you want the loan application to be approved as fast as possible. As you know, time is very important when it comes to getting your loan approved. Nobody will really drag on their loan application process unless they cannot get any loans approved. Any serious purchaser of any property, whether it's for your own stake or investment, will love to have their loans approved as fast as possible, ideally on the first try. So this tool that we have come up with will enable you to achieve that because it lets you plan and gauge the likelihood of banks to either reject or approve your mortgage application based on the income documentation that you submitted. Now, disclaimer, this tool is not foolproof, but it is built in such a way that it will, based on whatever information that we have gathered from our inside sources so far, of how banks actually sees how much income that you are actually earning, how they perceive your income level. You might think that you are actually earning 15,000, 10,000 a month, but banks probably do not perceive it that way. They perceive that you have an income that is less than that, especially if there's a certain portion of your income, or whether either it's rental income or commission or overtime, that varies from month to month, what we call as a variable income. Now, if you want to use this tool, you want to actually speed up your current or future loan application, I could actually let you use this tool for a one-time fixed fee. What you need to do is to click on a like on this video and then post a comment below, I want it, for me to actually reply you the link where you can actually get this tool. This tool will also help you solve the third problem, which is to figure out the reason for banks to reject your loan application. Because let's face it, if you're going to ask banks, like, why is your loan rejected, they're not going to tell you. But the answer lies in this, the debt service ratio. So using this tool will let you make an educated guess on why they actually reject you before they even reject you. So you can plan ahead to speed up your loan approval by only going for banks based on what this tool tells you, because you only want to go for banks that will perceive the income you declare as high as possible instead of on the lower side. Can you proceed with your mortgage application or choosing a bank without these two? Of course you can, but it will take longer and you will actually have to go through more trials and errors.